As professor of valuation, we know you pay close attention to equity risk premiums. Why do investors need to be paying better attention? Explain.
It becomes the ultimate receptacle for all your hopes, your fears, your greed, and panic. Everything shows up in that number. So to me, it's a measure that you use to get a sense of where the market is right now. What are people afraid of? What are they hoping for? So if nothing else, keeping a gauge on what's going on in the market, that number is a number to watch, because as an investor, whether it's an asset allocation or valuing individual companies, it becomes a number that plays a key role.
And what does it show right now?
I mean, based on my judgment, it's about 4.4%, down significantly from the start of the year, indicating again that hopes won out over fear over the course of this year. The start of this year, of course, people were terrified of inflation and recession. That seemed to have receded by July, but who knows what the remaining 6 months will bring. So it's down from the start of the year, but it's not historically low. This isn't 1999 when that number was 2%.
Isn't that high level? It's higher than what I've seen for the street.
That's because people use a shortcut. They use the earnings to price ratio as their proxy for what you can earn on stocks. And I have no problem using that measure, but it's a very flawed. It's a shortcut. It's a back of the envelope calculation, and it understates what the true equity risk premium is.
Yeah, you make the point that some coverage of equity risk premium calls the metric somewhat esoteric. I guess I'm wondering how it applies to your current view of the actual market.
No, I think people use the word esoteric because they don't use the term equity risk premium. But in practice, everybody uses equity risk premiums. They just don't call it that. So when you say you're putting less money in stocks because you think stocks are overpriced, you're telling me the equity risk premium is too low. When you're telling me Coca-Cola is cheap rather than expensive, you're telling me something about the equity risk premium. So we might not use those words, but it underlies almost everything we do as investors, as asset allocators, as people valuing individual companies.
So what is the data that gives you, talk a little bit more about what the significance of 4.4 is and what that tells investors to do.
Well, I think here's the catch. If you're looking for an indicator that will tell you what the market is going to do next year, I have some bad news. None of the indicators are going to tell you that. Whether it's earnings to price ratios, whether it's dividend yields, whether it's cash flows, whether it's momentum indicators, you cannot predict markets over the next year. And the sooner we accept that reality, the healthier the discussion becomes. If you're looking at the next 5 to 10 years, there is predictive power. So when equity risk premiums become low, the returns in the next 10 years are also low. But here's the catch. It's over the next 10 years. Whether they will become low in years 5, 6, 7, or 8, or whether they'll become low in years 1, 2, 3, or 4 makes a big difference. I mean, that's why market timing, I call it the impossible dream. Everybody does it, but nobody pulls it off.
Aswath, can you briefly talk about which elements or parts of the market right now you think are the most mispriced?
I think tech had a really good run this year, especially big tech. And it's been a very, very selective run up in tech. It's not all tech. It's big tech, profitable tech that's got. And I think the market is overreached, whether it's Apple or Amazon or Tesla. And I think you're going to see some cleaning up happening because of that overreaching. Does that mean we'll go back to 2022 levels? I don't think so. I think we'll remain above 2022 levels when markets overreacted in the other direction. That, again, is a feature of these stocks, right? Markets never get it right. They overshoot, they undershoot. And rather than wring our hands about how crazy markets are, think of it as an opportunity. If you haven't owned any of these stocks, you will have your moment sooner rather than later. So if you wanted to own NVIDIA, it might come sooner for you than you think.
Well, how do you factor AI into your traditional valuation analysis?
I mean, AI by itself can't pay a dividend, right? AI has got to be converted into revenue. So in the case of NVIDIA, the answer is easy. They make money by selling the chips that run AI. In the case of Microsoft, it might be a subscription model. AI is just an entry point. You've got to tell me how you plan to make money on AI, and then we can test out that business model. So are there companies that will benefit from AI? Absolutely. For most of the market, AI is going to be a cost. And I don't think it's going to give them a particular profit boost, because if everybody has it, nobody has it.
Aswath, thank you very much for joining us. Good to get your latest thoughts on equity risk premium from NYU.